Hello. Good evening, everybody. How are you guys? My name is Stanley, and welcome to Learn with Stanley. And today, I'm just so excited to speak to every one of you. And I hope you can hear me well. If you can't, drop down on the chat box, and you can let me know if you have any difficulty in viewing these slides and my voice, right? And just good evening, everybody. Today, I'm going to spend a little bit of time to talk about something more practical, right? Which is how to go about selecting the stocks that we want and analyze the stocks on that we want to invest into our portfolio, right? This will not be a theory-based process where we talk about the ideal condition on the perfect stock to look for, but rather what is the practical process that I actually use over the last 16, 17 years. And I have made many mistakes over this period, invest in many stocks that has cost me a lot of tuition fee. And I like to just share with you at the end why I have formulated this process and why it has worked for me. And also share a little bit of what are some of the other alternatives, right? And then later on, we have a Q&A session. Of course, if you have any question, you can definitely check with me, and we have a chat later on, right? Just good evening to everyone. If you have just joined me, why don't you pull up your chat box right now and just tell me, right, where are you connecting from? Have you had your dinner? What was your dinner? Did you have a pizza or something? Let me know what what you had for dinner, and let's get started. So today is a no BS guide to investing, right? Hello, Elvin. Nice to see you. Wow, I can see that your question is already starting to come in. I love that. I love that, and you can let me know. I'll definitely go back to your question later on in the Q&A section. But let's go through some of the things that I have prepared for you guys right now. Hello, Glenn. Hello, Freddie. KFC. I like it. All right. So once again, my name is Stanley, and I run the YouTube channel called Learn with Stanley, and of course through my website as well, both learnfromstanley.com and valueinvestasia.com. And I do run, just to let you guys know, I do run a premium club, and a lot of the things I'm sharing here are snippets from what I share to my premium club members. And I actually hold a monthly webinar with them that we go into much more detail compared to what we're going to discuss here today a little bit, due to a little bit lack of time. For the premium club members, we tend to drag on as long as they want to chat with me. And from there, I mostly share with them some of my stock analysis, even looking into funds and ETF, and how do you select things like that, backed by my actual portfolio, so they can see my own portfolio and see why I invest the way that I invest. And then later on, I have a section called spin-off as well. I just share with them some of the interesting thing that I find over the past week or so, that I wanted to highlight to them, right? That's a brief summary of my Value Invest Asia Premium Club. Okay, and today we're gonna just split into a few sections of what we're gonna discuss. A big part that I'm gonna spend more time in is a different investing strategy that in the market we will see, right? When we say about investing, not just value investing, but rather fundamental investing in general, we're going to share with you what are different school of thoughts, be it either value investing, growth investing, dividend investing. It doesn't matter, but it falls into these two categories that I call MCAAGP and GCAARP. I'm going to share with you what that means later on. But regardless of whatever strategy, fundamental strategy everyone use, I think they still fall under these two group set. And I'll share with you what are the process for these two group set, and why is it different, and you can select which one is more suitable for you. And then later on, we're going to dive a little bit deeper into actually what makes a company great, right? And what are some of the questions we have to ask ourselves? And when we're reading through the research or reading other people's research, right? Especially now in the age of internet, there's no shortage of people sharing their opinion with you. So when reading that, I always want to read with a little bit of skepticism, and some of the questions that we should ask also, if they have give a full rounded story of that company. Next, we will dive into a quick one on a case study, which is actually part of the webinar that I gave to my Premium Club members. And I'll use them as an example of what are actually the things that I go through with my Premium Club members step by step, and different things that we chat about during our internal webinar. And then and last section, I'll leave a little bit for later, but we can go through. Okay, so this is the key part right here. When we talk about investing, right, it's such a big scope of things. But when we come to equity investing, right, there's basically we can categorize them into these few areas. One part is using technical analysis, right? That is something that I don't touch. It's not that I have no data point or experience or whether it works or it doesn't work. So I'll leave it to the expert on that part. But for me, I have always used fundamental analysis in my investment. And even within fundamental analysis, there are a few key ways that we can invest in the stock market. Number one is just using macro indicators, right? Talking about just following the macro environment, right? What is the GDP expectation in the future? What is the Fed's doing about interest rate? Understanding the relationship on those, and then just investing maybe in the broad market. Second one is called sector analysis, right? We just learned about a particular sector that maybe we are working in, or a particular sector that we are interested in. Say, for example, I myself invest a lot in the tech space, and a subset of that is tech space, tech company that is dealing with direct to consumer, right? They have they are facing, say, Amazon with direct to e-commerce, or even Facebook and Google that serve the public through their social media and through their search function, and how those business works. And once we identify maybe this sector is something that I believe will grow for the next decade or two, has a tailwind behind them, then we can invest directly into the entire sector, either through ETF or selecting some of the few good companies within that sector, right? That the detail, the how you want to invest in it can varies, but the general direction is that you analyze the sector and you are interested in moving into this sector. And then the last one, which is what we're going to talk about today, will be understanding and selecting a particular stocks, right? A company, and how do you view the company in totality? How do you value them? What are the questions we should ask? How do we identify the risks that we are taking on when investing in these stocks? Right? These are the things that I want to focus a little bit on today, right? So apart from viewing this webinar through Zoom today, which most of you have joined into the Zoom session, but if you want to still share this Zoom session with your friends, you can definitely still continue to forward the link that I sent to you to friends and family that you feel they will benefit from this session as well. Or if you're just on the road, you can even just view it from our YouTube channel, right? We are live streaming it on YouTube Live right now. So from there, you can view it through YouTube Live. I think there's a little bit of lag from that, maybe a 5 to 10 second delay when you're viewing in YouTube. But that could also be a link that if you want to share with your friends, you can share that through that link as well. Okay, so when we're talking about stocks analysis in particular, this is the two key school of thought that I think most people would be looking at, which is MCAA GP, which is mediocre company at a great price, or GCAARP, which is great company at a reasonable price, right? This is what Warren Buffett talked about, right? Previously, when he first started investing as a Graham style investor, he would be investing mainly through the mediocre company at a great price, right? He's always looking for stocks that are, in terms of price, very, very undervalued. So you can say maybe this is, buying a used and rundown Toyota, right? It's not in very great condition anymore, but you're able to buy it at a very great price, and still it will be useful to you, right? And another one is buying a great company, which is what Charlie Munger pushed him to do later on in his investing life in Berkshire, right? So once starting into Berkshire, Charlie Munger actually pushed Warren Buffett more and more into using this strategy of investing, which is finding great companies, top of the top in the industry, and then just waiting to buy them, not at a great price maybe, but at least at a reasonable price, because great company will appreciate over the long term anyway, right? Just like if you buy a vintage Ferrari, the value is there, and over time, actually, it will increase in value because it becomes rarer and rarer, and more people want to own that stock or that car. I myself, I started investing since 2006, right? I started working around 2004 and 2005, and once I have some saving, and I'm lucky that my dad also helped me out a little bit to get me started in life, which he has gifted me a small sum to get started as well. And all those money I started investing into the stock market in 2006, basically. And at the time, I was basically just shooting darts, right? I was reading all the stock forum. I was following the newspaper at the time. Most of the time, I'm still reading newspaper back in 2006. And I will go through the 52-week low price at the stock business section. And I always find the stocks from there. So I started out very much at finding mediocre company at great price kind of strategy. But over time, I think maybe as I'm getting older and older as well, what I found is that this is very hard to scale this kind of strategy. The time and energy you need to spend in finding this kind of company never end. And there's no point where you can actually reach financial freedom where you have time within yourself. Mainly because, so the process will go like this. The process for finding mediocre company at great price is, first we have to screen for it, and then we'll have to analyze it and match that to the valuation and see that, okay, maybe this is not such a great company, but maybe it's still doable, right? And the price is so good, the risk reward is there, and then we buy it, and we have to constantly monitor it, because bear in mind, this is not a great company. Anything can happen, right, to this company. So we have to monitor it, make sure that it's progressing as our thesis go. Sometimes our thesis, sadly to tell you, our thesis sometimes might not be right all the time. So we have to monitor it. And once it reach our target price, then either we have to rebalance, or if we feel there's still leg to grow, or we have to sell it. And once we sell it, we cannot buy this company back anymore because it's no longer at a great price. And then we have to do this process over again and screening for new company. So every time we sell a company, we have to find a new company, which is a lot of work, right? Alvin, I saw your question, how old am I? Right, I've been investing for 18 years, I think, right till now, and I'm actually 40 already this year, right? But so I think since the last maybe 7-8 years, I started to move more and more towards this strategy, which is finding great company at a reasonable price. You can see the process is roughly similar, but there's a key difference here, which is I can screen for it and then analyze it. I find a value for the company, and if I feel that it's a reasonable price, I buy it. Although I still need to monitor it, but I don't monitor it so often, right? Mainly, if you say I own a company like Apple today, I think the last time I checked Apple share price is like 2.5 years ago, and the development of the company, I just automated. I just using, once in a while asking proximity AI now with AI. Then what's the new development? I follow YouTubers that review tech products, so they always review Apple products, and you can get the feedback from there. Not a lot of time. And this great company, the beauty of it is I can keep it for a long time because it's a great company and it's growing for it can compound its growth for a very, very long time. So all we have to do is either it becomes too big in my portfolio, I have to rebalance and sell it down. I did it a few times with stocks like Facebook, where I think it became like 15 or 20% of my portfolio. I had to sell it down because it's just too big. It happens to me once with even for Tencent, right? Before the China market started going down, Tencent was at a bull run in the past 4 or 5 years, and it reached a point where it's very big for my portfolio. I also have to sell it down a little bit. But once it rebalances, I still keep the shares. I don't sell out completely, and I just keep waiting and waiting. So the key difference between the first strategy and the second strategy is I don't have to do so much work because I find a few great companies and I can just hold on to them because I am quite certain that if they continue to be great, they can continue to grow and improve over time. And so it comes down to how do I find the great company? What makes a company great? In my mind, how do I understand it as a great business? Of course, this is not all from my own thinking, but rather just throughout the decade of reading a lot of investment books. I think the most influential one for me is the one by I can't remember the author name, but the Warren Buffett Way, which is extremely good. I learned a lot from that, and also the book from I can't remember already. Such a long time ago, maybe 15 years ago, by Philip Fisher, right? Which is talking about how do you search for also great company, right? And I'll probably share those key books that have influenced me in a Facebook post later on in after the event. But after reading 20, I think close to 30 books on investing, I summarize them into these few areas that we have to focus on to understand a great business. Number one is finding a business model that we understand, actually, right? Let me switch off my face for the moment because I think it's blocking the view. Okay, so finding a business model that you can understand, that's key, because some company that they might be saying, everybody must be saying that, oh, it's such a great company, but if you read about it and you don't understand exactly how they're making money at all, it's very hard to have that kind of confidence in the company to hold it for a long term, right? And because a great company is a company that we can hold for the long term. A lot of the stocks that I own, I have been holding them for the past 6, 7, 8, 10 years. And so to have that kind of confidence and be relaxed if a big part about of your wealth is in that business is something that you must understand first, right? So this is more on for a personal level. We have to understand the business model. Second one is understanding growth, right? Understanding growth. And growth, I put it down into 3 key parts that we have to look into. It should be growing in revenue. It should be growing in profit. It should be growing in cash flow. Even if, say, maybe some tech growth company doesn't have a profit yet or doesn't have a cash flow yet, that's fine. That's fine. But when you look at it, you should be reasonably confident that it can reach a profit one day. It can reach cash flow positive someday, right? I typically look for a company that is at least growing around 10% for all these 3 metrics, right? If they don't have profit or cash flow, maybe I want their revenue to be growing a little bit faster, just to offset the lack of profit or the lack of cash flow for the moment. And why we have to monitor three key parts instead of just one, right? Why can't we just buy, oh, this company is growing revenue, that's good, right? Because they all mean different things at the end of the day. A company that can grow revenue fast, it is kind of showing to me that okay, its product or services is wanted by the market. Right? The market is actually yes, the market is having higher demand for its product, so it can grow its revenue. That's good. And then the profit must grow because the company need to actually generate profit from their revenue. They can manipulate growing revenue, right? By giving incentive. That's how maybe at the beginning, say a company like Grab, a company like C Group or Shopee, they can grow revenue just by subsidizing the drivers, subsidizing the customers, and people will use it because it's almost a no-brainer to use their services and product. But it's not a sustainable type of strategy, right? But of course now the caveat is if they can monopolize the market, then they can make a profit, right? Case in point, like Grab, if they can monopolize it, then maybe they can squeeze out the profit later on. And that's similar for cash flow as well. Sometimes a company with huge paper profit might not really have a huge cash flow. And we have always to match it out. So it's good that they have paper profit, that's good. But I want that to translate into cash at the end of the day, because without cash, the company cannot really operate, right? So that's the key part. The last part. Sometimes it comes, if you're buying like, a startup type of company, the cash flow comes at the later stage. So they will start showing revenue first, then they might show a little bit of profit, and still negative cash flow. And after a while, they will start showing cash flow. But once in a blue moon, you might find company that have all three right from the start. And these kind of company are companies that is completely creating a totally new market, right? A never seen before market. Right now, of course, most of the talk is in AI, but I still can't see how most company will create a sizable business, not sizable business, like a sustainable business model within AI, how that would change. I can't really imagine it right now. But if we go back right at the start of the creation of all the tech companies, some of them, when they first started out, they are showing profit right from the start. Company like Facebook, company like Tencent, company like even Alibaba, because they are completely reinventing the entire industry. And when they get started, you can see like in Tencent's, I think 30 years of history, once they turn profitable within the second year, they have never recorded a loss at all throughout their history, right? And their cash flow was cash flow positive, I think, from year 5 or 6, I can't remember, but very, very early on, they also cash flow positive, and they have been growing ever since. So once in a blue moon, you find these kind of companies as well. And then another thing to think about is also the addressable market on the company. So they can be growing on paper, revenue, profit, and cash flow, but we want to see how big is the addressable market as well. And which is also why, if you look at my portfolio, if you're on a premium club member, when you look at my portfolio, you realize that I tend to just invest typically in US companies or US stocks, and also in Chinese stocks. And mainly come down to this, the addressable market, right? There are great companies in Malaysia, there are great companies in Singapore. Not a lot, but they are. But some of the key issue is that their addressable market is just not that big enough. They can, in my lifetime, it's very possible for them to reach a saturation point, right? So you can say that a company, just now I saw that Alvin is asking 99 Speedmart, right? 99 Speedmart is going to IPO soon. And that's, such a company, say a well-run convenience store, mini market type of businesses, right? It's a great business, it's profitable. But maybe the addressable market is not that big enough for me as an investor. Right? If the same model, say, happens to be in the US and is growing very fast, or is this similar business model as in China and it's growing very fast, I would be more attracted to the same business but in that market, mainly because I can be quite sure that in my lifetime they will never be able to reach saturation point in their entire market. So that's something to take note of. Next one is what we call moat, right? I think this is a famous term made by Warren Buffett, economic moat. But short form, we just call it moat. And it's basically the competitive advantage that the company has to keep away competition. So what exactly is so special about this company? I was actually just chatting with some of my friends, looking at the sportswear industry and sports fashion industry, and I'm just trying to understand, a new company like On's or Under Armour, which has saw its stock price decline so much, right? It's looked quite cheap right now, and I just trying to understand. Yeah, I know it's cheap. I know this company is not doing that well right now, but does it has an economic? But why is it? What makes this company special that can keep competition away? Why how is it different from Adidas or Nike? Within that industry, it's quite hard to find that kind of moat. But in maybe another industry, maybe like the tech industry, then we look at a company like Apple. It's quite clear what is their key competitive advantage with their wall up garden, right? And once you're in their ecosystem, you get stuck inside. And a key part that is also key. That is also true for, say, company like Microsoft and also Google, right? Especially now with their cloud storage business. Even as a consumer, once you keep your data within them, most of the time you become very, very sticky to them, and you just stay with them, and that can become a competitive moat, right? And that's where they can earn a lot of higher margin from the customer. And one of the key way how I identify if this company has a moat is by looking at its profit margin, right? Company with good and sustainable economic moat typically has much higher profit margin. And because they have something special and people are willing to pay a price higher for them. And so this is something that we'll look at later on. And also lastly, which is just financial strength, right? I like to look for company with good return on equity, meaning that the money that we retain in the company, they can continue to earn a good return from it. So return on equity, right? How much money they retain, they are able to still generate good return. Liquidity, mainly, if their cash flow is doing well, and also debt. Make sure I don't like company with too much of a debt. So that's something to look at. Typically, what I look at is I want company with ROE, with return on equity more than 15%, and I want company with debt ratio, so debt divided by equity, not more than 1, and preferably with a lot of cash in hand. And actually, a lot of time, company that I end up investing in is in net cash anyway, right? They don't really have debt at all. Okay, so this is an example that I went through with my Premium Club members, which when we are studying the addressable market for ANTA and Li-Ning, which is the sportswear and sport fashion, I guess, twin giant in China. So the addressable market for them, of course, is China, and still growing, right? Their sportswear market penetration is not as great as developed market like US right now. So within them, they still can grow, and they can actually continue to expand it, because mainly right now the sports that they are promoting are basketball, running, or they are famous for racquetballs, their ping pongs and badminton. But there's still a lot of other sports that Li Ning and Anta can enter into, and especially one key part that they are targeting is actually winter sports, right? And that could be much also another key market for them, especially when winter wear are much higher in price in general. Okay, right. And maybe before I go into the the second part, I'll take some question. I see that while I'm talking, I can see that you guys are putting in a lot of questions, and I like to chat with you first. Up to Let's stop for a minute and let's go to questions. Okay, I don't think you can see it from your page. I'll just read it out of what you guys send me. But if you're in Zoom, you can pull out the chat group and you can see the question from other people as well, right? Gary is telling me, I think, okay, that's the book that I'm talking about, Common Stocks and Uncommon Profits. And the Warren Buffett Way, one of the few good books that I read about investing and stock analysis. And okay, one person called Zoom User is asking me, are you still investing in Hong Kong, China tech companies and all? The answer is yes, I'm still invested in it. Not doing that well for me, I'll be honest. I would say that right now, maybe China stocks. I haven't do a quick allocation view, but I think China stock is maybe about 20+% around allocation for me in my portfolio right now. The others are mostly US stocks, and just it's not something that I purposely have this separation, this percentage allocation. Just that the US stock has grown a lot and the Chinese stock has shrunk, and that's roughly the rate I have now. I have no plan to sell my Chinese stocks, and in particular, I think I'm still quite happy to hold on to, especially the tech companies. So I own companies like the usual Alibaba, Tencent, JD, I think I have. And in some of my smaller, I guess, family portfolio, I would just invest in the Hang Seng Tech Index directly. And I think generally because that's the main one that the main sector in China that I'm more optimistic about. And I tend to just, after a while, I realized that if I just invest in the tech ETF, might be actually a simpler way for me to go. But there's I guess two companies in China that is not in the tech sector, but I still invested in them. One I'm very optimistic about, which is Guizhou Maotai. They only have it on A shares, so I bought the A shares on that one. The other one, I wouldn't say I'm very optimistic about it, but I'm still okay. It is a very, very small position for me. And that company is Haidilao, which I have a little bit as well. Okay, thanks. Freddie is asking, how about S&P 500, all the great company in this ETF? Yes, you hit the nail in the right in the head. Actually, going with just buying an index fund ETF on S&P 500 is a great way, which is something that I'm leaning more and more towards. After a while, I realized doing all this, especially as I get older again, like I explained just now, I'm no longer searching for the maximum return that I can get. Maybe, average is fine. And investing in S&P is actually a good choice. Mainly because they already consolidated the top 500 companies in the US, and this index is what's the word called, self-positive rebalancing, because the company, if they become weaker and weaker, they got dropped off by from S&P, and they get replaced by company that has a chance to grow and flourish. And companies within the good company and the great companies within it will grow bigger and bigger, becoming a much bigger allocation within the index. And that's good. Having said that, buying S&P passive ETF, it's still, they have its risk, which is a key risk is one day, I think sooner or later, we will face a ETF bubble, right? A passive investing bubble. We're not there yet. I don't know when we will, but I'm quite sure, regardless any asset class, we will face such a day to come. But over the long term, I feel we'll still overcome this bubble. And in my lifetime, I'm still quite optimistic just buying S&P 500 ETF. The reason why I say that there's a chance that we will definitely face ETF bubble is because passive investing, as it become more and more popular, it caused us to simplify it a little bit too much. Like just blindly buying the S&P. So regardless of valuation, regardless of what's happening, everybody might reach a point where they realize, hey, I just invest in this ETF is actually doing much better than all the mutual funds or the unit trust I'm doing anyway. And as more and more people believe that and pile into it, it becomes a frenzy. It will make the index shoot up much even higher. We see that a little bit during COVID. And when that happens, then everybody get FOMO and more people buy, and you'll definitely reach a point where the bubble has to pop. But because S&P is made up of high quality businesses, when it pop, there's still a good chance that it will recover. Okay, something like that. Look, that's the theory happening in my head. Alvin has a comment. Like Palantir, yeah, a company in the US, thinks they're serving the US government. Yeah, right. A lot of people are talking about it. But I read a little bit about it, read through some of its annual report. Yeah, I don't understand it at all. So it's not a company that I am talking about anytime soon, because I feel I'm just wasting everybody's time if I talk about it as I don't understand it a lot. Next question by Richard. It's asking how many % of growth is considered good? I think this is a question that links to just now when I'm talking about finding growth in the company. I think I stated I want company that is at least 10% growing on all fronts. That's based on US dollars, by the way, right? So when I investing, I always think in terms of US dollars, because US stocks is the main thing that I buy. So if you're investing in, say, a country that the currency might not be that stable, like our Malaysia or even China, right? That growth ratio put it a little bit higher, right? I think Malaysia ringgit over the past 5 years depreciate compound yearly. The CAGR is depreciating about 4% a year over Sing dollar. So, a Sing dollar return of 5% on one of the REIT is actually a 9% return in terms of ringgit over the past 5 years. So we have to adjust a little bit, but just assume when I'm talking about the companies or growth rates, in my mind, I'm thinking US dollar most of the time. Next one is Gary. How do you manage currency risk? Because US dollar fell against Sing dollar and I lost money due to currency change. Wow, Gary, you don't know how jealous you make all the Malaysians here, like myself, that you can your currency can actually strengthen against the US dollar. Yeah, but currency risk definitely is something that you have to consider. But generally, I think that especially if we are investing in great company at a reasonable price, the growth rate of this great company, at least for me in my experience, has offset any currency risk that I have experienced. Even in terms of Sing dollar, if I view it in Sing dollar versus my stocks in the US, because the key thing is it's almost impossible to find this kind of high quality, high growth company in Singapore anyway, right? Maybe except iFAST, I guess, over the past decade. but yeah, it's very, very hard to find that. And so typically, if you want to remove that currency risk and only invest in Singapore, then the expected return from that market is much lower anyway, right? But the expected return for me when I'm investing in the US market, I'm expecting, excuse me, I'm expecting much higher. So they, in my experience, they have been able to offset that currency risk. So I guess don't buy dividend stocks in the US if you're afraid that Sing dollar will appreciate against the US dollars, because then the growth will not be able to offset it. Richard again asking, do you look at return on asset, ROA? Yes, I do, but typically I just focus on return on equity. But mainly because I look at companies with very, very low debt level. So the return on equity and the return on asset are relatively still in healthy range that I want. The only way that ROA can tell a different story from ROE is when a company is highly levered or extremely high in debt, because they can earn maybe 1-2% in ROA, which is the return on asset, but because they use so much debt to do it, their ROE become like 15%, which when you look at the ROE, wow, it's good, but the ROA is not that good. Right? Case in point, a lot of banks do that because their leverage is so high. But because typically the company that I look at, first I look the debt level, right? It's not too high. So whether I look at ROE or ROA, it is roughly the same. Not too much different. William, this is a direct message, so some of you might not be able to see it, but William asks, on average, how many times do you trade a year? I don't have a direct, I don't have definitive number for you, but I would say maybe less than 10. But this is from a point where my portfolio is more or less already formed, right? Of course, when I first started and start building your portfolio, then that's different. Or if I'm starting my portfolio today, I'll probably just have a dollar cost average strategy. So maybe once a month or 2 times a month, when I save up that amount, I'll just invest that amount, regardless of the market condition. If that's the case, then maybe I'll trade like 20 times a year on that. Plus, I don't sell, right? So I cut down 50% of the trades because I don't sell, I only buy. But yeah, I trade very, very little. And I check my portfolio very, very seldom as well. Typically, I check them maybe every half a year. Sometimes if things are not, not much different, I can go on a little bit longer. Sometimes, but when my wife asks me, then I have to do a portfolio review for her because she's my largest shareholder with my portfolio anyway. So I have to report to the board of director. Okay, thank you. And next question is Gary. I guess this is more of a comment. Gary say that Guizhou Moutai is the most profitable company in China. Yeah, I guess should be one of the most profitable ones. It's just such a long historic brand and historical value in that brand that I think it's one of the biggest brand in China. William again is asking, he say he's curious how my portfolio look like. Example, major profit from dividend or stock growth profit. Yeah, so at this point, okay, so this question I think need a little bit of explanation, mainly because okay, I'm looking at it from my current position as a 40-year-old still working. My wife is also working, so the key objective of this portfolio that I'm building is for my kids' education, and a little bit for future rainy days, or if I'm not able to work in the future. So dividend is not that key important right now for me. So I don't think I have any REITs, or if I have, it's just one or two. And most of it is companies that has reasonable growth potential that I'm seeing. So most of the profits still come from stock growth rather than dividends. But of course, a lot of these companies, especially US ones, they don't give dividend anyway. How they return the money to shareholder is actually through share buybacks. So a lot of companies are buying back shares extremely fast. And that is a form of dividend, but we just don't see the physical money, right? But that should also help boost up the earning per share of the company, and in turn boost up the stock price of the company. Yeah. So I think, yeah. And my portfolio over the past 16, 17, 18 years, average around, since I start tracking it, average around 10 to 12% yearly return, again, in terms of US dollars, yearly return. And I guess it's just in line with the broad market, because US has done so well. But I have always expected that my portfolio should do a little bit worse than the S&P 500, mainly because I invest in China as well, right? My idea is, the macro view is, I don't know who is going to win, China or US. I don't know. I have no skin in the game. I don't care. But so I want to have leg in both sides, right? So I invest in both. But it's impossible. I guess now it's quite impossible for both to grow together. So one will grow faster than the other. One stock market will do better than the other. But I wanted that diversification, so I'll take that risk. And so US market has gone up, China market has fallen down. Blended, my portfolio should not do as well as a straight up US focused stocks, right? So that's something like it. Thank you for the question. Next one, Gary, is do you do crisis investing? Buying regional banks when price fall, say like Silicon Valley Bank or Silver Lake. Okay. I tried that when I first started investing, but I don't really look at that. I say I don't actively look at those. When something happened, my idea is always, if there's a cockroach in the cupboard, there's typically more than one. So that's my view. So when people start seeing cockroaches coming out, I always assume the whole cupboard is already invested lah. So I try to stay away, something like that. I'm just trying to think if I have actually invested in such a falling knife kind of situation. I can't remember, right? I don't think so. But that doesn't mean that I'll never do it lah. If I do look at stocks, when they come on the news or come into my radar, but typically I don't look at a company that is purposely in a crisis mode. Thank you. Freddie is asking, the dividend US shares tax 40%, right? For non-US residents, our tax is on dividend is 30% withholding tax, right? I think that's the same for both Malaysians and also for Singaporean. As long as you sign the W8 band form, then that we are taxed at 30% withholding tax on US dividend, which is why US companies tend not to give a lot of dividend anyway, because their locals resident, their dividend is also taxed higher than their capital gain. For us, we're in a good spot where capital gain from stocks is not taxed in Singapore. Hopefully not gonna be taxed in Malaysia. You never know. But yeah, so US dividend is 30%. Next one is on Alvin. Will Asia the dollar? I guess you're talking about will Asia Pacific as a whole stop using US dollar, right? The dollar rise. Stop using US dollar. Okay. I know there's been talk for it. I myself is not a currency expert, so I would just say as a caveat, I'm a layman when it comes to currency. But what I'm seeing and what I feel is that no way is any country strong enough to not use US dollar at all at the moment, right? Not even China, not even Japan. Because the US will still, for the foreseeable future, be the currency of the world, right? The reserve currency of the world. You say just for example, if China want to become, right, the currency itself is not even open. It's not fully internationalized. That's what are you talking about becoming a reserve currency when it's not even easily available? And for most very, very rich Chinese, if China is today is to allow them, okay, you can change your renminbi as much as you want, right? The effect is actually that most of these Chinese billionaires is going to move the money out. Similar case like Malaysia. People are trying to move the money out because it's still a developing country. There's still risk as a country for this country. And if I'm a billionaire, I want to diversify that risk, which is why Chinese money has been flowing anywhere in the world, right? Not just our part of the world, especially Singapore is a great beneficiary of that, but actually going everywhere across. And that's because they wanted to move so much money out. And now the Chinese government, instead of liberalizing the currency, they're actually increasing the control, right? I think right now Chinese locals, they can only change 50,000 US dollar a year per person, limited, right? So the most you can change is 50,000 US dollar out of renminbi. The rest you have to keep it in renminbi. Yeah. Okay. So I think I'll just go to a last question and then let's go back on finishing up this presentation a little bit. Freddie is asking any great website to select great stock in US and Singapore. Okay. So actually a good one that I use is Morningstar that I look at. But even the local brokerage, iFast, FSM1, they have a screener. I tend to just use that. I think it's good enough for us to use. Okay. Okay, still great. Thank you for the question. And this is also a slide that I just want to share with you, something that we gone through during our Premium Club internal webinars. We're just looking at how macro trend is good for ANTA and Li-Ning, right? And we also do swap analysis. So every company that we look at, we actually do something called stock of the month, right? So I'll talk about one stock, my favorite stock for that month. I'll look into different kind of stocks. Maybe not always saying that this is the best stock to buy right now, but the one that I find it most interesting. And we go through a stock analysis for the company, right? What are the key strengths of the company? What is the weaknesses? What is the threat, right? Say for competition, for regulation, and what are some of the key opportunity for this company going forward? And I do what we call the moat rating that we talk about. Does this company has a moat? Does this company have moat? And every company that we go through, I actually go down this list with them and have a score. That's how many star that I give this company on its moat rating. 0 star meaning no moat company, and then 5 star meaning best of the best. As case in point, I actually gave a 0 star in one of our webinars, which is Singapore Airlines. Sorry. I deem it as a 0 star company, a 0 star mode company. And then a 5 star, maybe I'll give an example, Apple. Right? Apple is a 5 star mode company. And some of the things that we look through is economic of scale. Does it have economic scale? So big that it's very hard for other people to come in. Branding, does it, in the same product, I rather buy the one with this brand rather than the others. branding. That's the branding effect. Network effect, right? Because everybody is on the social media, so this social media tends to be the one that got all the profits. IP, is special type of intellectual property that they have, other people cannot have. High startup costs, company that has invest so much into their equipment or their research or their coding, that is very hard for new startup to fight them, right? Your company like your Google, company like TSMC, control of resources. If a company can corner the supply that is used to make that for them, then they can control the resources, and they will have they will corner the market. And then lastly, switching costs. I talk about our OneDrive or a Google Drive. If all our data, pictures of all my children is in OneDrive, next year you ask me if I want to renew it, most likely I have to renew it. Right. Okay, so this is just an example I give for Li Ning and Anta. And we also look at the risks, key risks, talk about in detail. Now, what are some of the risks? Every company has a risk. So when we look into it, what's the key thing that we have to focus on? If this risk materialize, then we have to rethink this thesis, whether we still want to own this stock or not. And then, of course, we will go through their financials, looking through their annual reports, their presentation, how fast they're growing, what actually is making the bulk of their money. In this case, for Anta, you can see that they make the bulk of their money actually from apparel, and then a big part from shoe as well. And they have other different brands as well. Anta is actually the owner of Fila China. You see, so Fila in China is actually fully owned by Anta. And their profit margin in terms of all the different brands and businesses. And we want to see that the profit margins stay roughly the same. And increase will be better, right? Meaning that they are able to have some pricing power. Right? If a company has a margin, constant margin of single digit, 2-3%, it's very hard for me to get excited about this company, mainly because I feel that they might not have a competitive edge, and what they are selling is just fighting on price, and that's a problem. Okay, and then lastly, of course, we look at valuation. I share with my members. Actually, we have a few different type of templates, but even for like discounted cash flow, Excel template that I'll share with them on coming out with valuation. But of course, here the key thing is we're not going into detail on this one today. But to be honest, I would say this is not that big of a deal, because valuation is really very, very subjective. The valuation I come up with will be completely different with you. And as long as you know the basics of how to come out with a valuation, then that's fine. Stick with your own valuation. We'll in the premium card, we'll go through my way, and I'll share the templates where you can change the number to something that you prefer and come up with, and it will generate the valuation for you, and you can compare whether this company in your mind is overvalued or undervalued. And then the last thing that we tend to talk about is also, yes, this company can be perfect, but is it really suitable for you? Is it suitable for your portfolio? Does it fit your objective, right? Investing is not really just about just making money, right? It has to suit your investment objective. If all we are chasing is, listening to friends that, wow, this stocks is gonna shoot up to the sky, everybody run into it. It's very hard to build long-term wealth in that way. Right? Long-term wealth is built with a slow and steady strategy. My portfolio, for the first maybe 10 years, is not that meaningful, right? It grows, but that amount that is generating from return is not life-changing for me. But over the last few years, it has snowballed to a significant amount, and and my return from the portfolio is now actually quite sizable for our livelihood, and but it takes time, right? For me, it takes about 18 years now, right? I would say that we can fully dependent on our stock portfolio return, not yet, but it has already become quite a meaningful sum for us, and that's something that will be over time. I might still continue, right? If possible, to continue to keep doing this for the next 40, 50 years, and let it compound a little bit more as well, right? Okay. Yeah, we talk a little bit about portfolio as well, but that's not really something for today. So I just want to share with you guys. These are some of the things that we actually go through on a bi-monthly basis, so 2 times a month. And so I'll go in detail on a webinar with my Premium Club members on this. Sometimes we have one session that actually a members is so kind to share his entire portfolio with me, and we use it as a portfolio review and for the benefit of all other members as well, right? That is what's happening with this person right now. Of course, we don't divulge his personal detail, right? Don't mention his name or her name or anything. We just say that the situation is this. What are some of the portfolio that he has? What's his wealth or her wealth situation right now? And then we just look at what are some of the options that they have for them at the moment. How, if it's me, how I might rebalance some of the things. These are things that we talk about within Premium Club as well. And just share with you some of the old webinars that we've done. We done one with CapitaLand, done one with Singapore Airlines, Anta and Li-Ning. So all these are still on archive for our members. And we also have a spin-off segment, right? A small segment that I do once in a while. And sometimes it involves a free giveaway as well, right? Giving out a free book for our members. Yeah, so just sharing with you guys what you can expect. In the future, I'll try to share more with the public as well, with you guys on mostly on investing education, right? Different strategy. Like just now, we only talk about the small part on fundamental on stocks, right? Maybe we will have another session on actually how to create a passive investing strategy, which I think is actually one of the most optimal type of strategy for most people. And I just want to leave you with a small quote from Buddha himself. There's no path to happiness. Happiness is the path. And if you want to know more a little bit about what I do in Premium Club, you can actually check it out. I'll hide my face for a while. But you can go to this website, the shortened site, bit.ly.com/clubvia, or if you want to do the full site, if you can type in this, or you can just scan through, right? If you have a free phone around, you can actually scan this to find out a little bit more on VIA Club and our Premium Club. So thank you so much. If you have additional question, right? I feel we can have some time to look into more question if you have as well. And I just want to say a big thank you for those who have asked me a question. I really appreciate our conversation, right? To Alvin, Freddie, right? And William and Gary or Richard. Very, very honored that you will share this evening with me. If you have more questions, I'm happy to take them. Let me readjust my screen a little bit. Yep. But if not, these are, I just want to leave you with this slide. And if you want to know more a little bit about our Premium Club, where we talk much more in details on our both webinars, and also I provide written reports, and also my own portfolio will be stated in the website for all the members as well. And of course, we can have, and also we share, what do you call it? We have a Facebook forum that we can communicate with each other. I used to have a Telegram private group, but I just want to let you guys, all of you guys, know there's a lot of Telegram scammers that is using my likeness and my name and my Learn with Stanley and also Value Invest Asia on Telegram. And so I shut down all the channel in Telegram. So if you have Telegram, if you see me around in Telegram, just assume it's a scam, right? I don't communicate on Telegram at all. And I'll just type it down. Somebody is saying that I should type it down. .com/club. Yeah, this one, right? Oh, sorry, let me change to. Give me a minute. Yes, this is the website. Thank you, Freddie, for that. This is the website you can go to. You can copy and paste into a browser. Zoom user, you're asking, can you show example of how you value a company? Actually, yes. Give me a minute. I'll go back to my browser and I can put up the example for you. Give me a minute. I'm just flying through my folder right here. Okay, I'll maybe share with you. Let me see what I have here. Okay, maybe one of the first few that we have done, which is example on valuation for SIA. So this is one of the template that I have and one of the template that I use. Let me see if I can. Oh, too big. Let me see if I can zoom it in. Too big. Let me see. Okay. Hope you can see it. So something like this is one of the template that we have, where these are my own inputs, right? I explain to them what is why I put in all this, and it generates this table, and we calculate the value of its equity, which is the value of the company. And if you want to know it based on price, you can just use this divide by the number of shares outstanding for the company. But you can also compare it directly with, sorry, we can just okay, we can do it something like this. You can go to, say, Singapore Airlines, and you can compare it with this market cap. This is the market cap of the company, but my calculation come up with this one, right? I feel the value of the company is around 18 billion, it's trading at 19 billion. Then you can come to a conclusion whether you feel it's undervalued or not. And of course, this is just my assumption, and I encourage all my members to take this template and then put their own numbers, right, and see what they come up with based on their own assumption. So don't follow my assumption because those are mine. You should come up with your own. So something like this. All right. Great question. Thank you so much. And I hope you enjoyed this session today. I have definitely enjoyed myself. And again, if you want to know more about Premium Club, you can go to bit.ly.com/club. Yeah, that's just the short form for it. And thank you so much. And I'll see you in the next one. Till we meet again. My name is Stanley. Invest safe.